22 seconds away from the opening bell this morning. Good morning to you. Equity futures are just about positive by 0.1%. The sentiment improves a little bit off the back of the ECI, the Employment Cost Index for the fourth quarter here in America. That comes in a little bit softer than anticipated. Equities get a lift going into the open. There's the opening bell switch of the board into the bond market, and yields drop a little bit lower off the back of that too, down 4 basis points. On a 10-year, we break 350. 349.58 on a 10-year yield in the FX market. Euro dollar 108.60. After the Fed, you go to the ECB. The Federal Reserve expected to go 25 basis points tomorrow. The ECB expected to go 50 basis points on Thursday. Let's round things out with a look at crude. We're down about 0.6% on WTI, $77 and around about 40 cents. 20 seconds into this one, equities just about positive by 0.1% on the S&P. On the Nasdaq, up 0.1% also. One stock to watch at the open, Caterpillar, posting its first quarterly miss since the start of the pandemic as it grapples with rising raw material prices. For more, let's get to Abby. Hey, Abby.
Hey, John. Well, this one is interesting because not so long ago, just moments ago, it had been down just about 0.3%. So really all over the map, holding that loss that it had earlier in the pre-market after posting this first loss since 2020. It's not all bad, though. They also put up pretty solid revenues. They beat revenues, in fact. So it's really the profit miss, not being able to manage those margins for the first time on rising manufacturing costs. They also have a goodwill impairment charge tied to its locomotive business. In fact, we have some headlines coming out recently in the CAT CFO saying that the material and freight costs increased 20% since 2020. So until now, this company has done a very, very good job of managing those costs, and the earnings miss, it's less than 3%. So it's going to be interesting to see if this stock holds on to its loss. Right now, it certainly is down 2.5%. As for some of the good news, because, John, this is really interesting, and this is a surprise to me. Just last Friday, this stock at an all-time high. How many stocks can you say that about? It has something to do with this picture right here, that demand, record backlog, quarter after quarter, close to $30 billion worth of demand. So again, it's going to be interesting to see whether or not the 2.5% loss hangs out for the day, or if investors propel the stock higher on what are really mixed results, but the underlying demand is good. It's just a matter of managing those margins.
Down about 3%, 2 minutes in. Abby, thank you for that. Big international story here. Caterpillar bottomed the same day the dollar peaked at the end of September 27th. And since then, Caterpillar has rallied by about 56%. That's accounting even for this move lower this morning. So a bit of context over the last 3 months for you. Caterpillar down about 3.3%. In fact, make that the last 4 months now. Earnings also coming from the energy sector. Exxon holding back on announcing any new buyback plans despite posting a record profit of $59 billion. Kaylee on top of this one. Hey, Kaylee.
Hey, John, it's absolutely unreal, the numbers we are talking about for the full year. And for the fourth quarter as well, Exxon beat expectations, their 9th beat on EPS in 10 quarters. Contrast that with Chevron, that actually missed in its fourth quarter report last week, but again, also reported a record for the year. So these two companies together, these oil majors, have pulled in nearly $100 billion in profit over the course of 2022. But another contrast, as you alluded to, is Chevron last week announced it was upping its buyback program to $75 billion. Exxon, though, did not raise its plan. They left both the buyouts, the buybacks, and the dividend payment as is. They're planning $35 billion in repurchases for 2023, but that is after expanding buybacks multiple times last year, and the company has signaled its intention to repurchase $50 billion of stock through 2024. Interesting to note as well, in 2022, Exxon returned about $30 billion to shareholders. Global capital spending, meanwhile, was only $22.7 billion. So this is a major reversal from much of the last decade when CapEx was higher than those shareholder payouts. And that could add more fuel to the political fire as the Biden administration really wants these guys to be pumping more oil, bring supply up to put prices down. And Darren Woods, the CEO, actually addressing supply on the conference call just now, saying that the oil industry is underinvesting in new production. He sees the potential for continued tight global oil markets as some producers pull back. And in theory, John, that could mean upside to oil prices.
Looking for the White House commentary on that maybe a little bit later. Looking forward to that. Kaylee Lights, thank you. About 4 minutes in, we are positive by 0.2 on the S&P and the Nasdaq, up by 0.4%. Snap reporting after the closing bell as it heads for its best month of gains since 2021. Investors expecting results to shed some light on the state of advertising. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, that's the thing. Snap matters because it's one of our first looks at what online ad demand looked like in the fourth quarter. We know that it's been a sore spot for the industry at large and for Snap in particular. If you look at shares over the past year, I know they're up so far this year, but train your eyes on these red circles. As you can see, its last two earnings reports sparked sell-offs, and you can't forget when it cut its forecast in May. That's when the pain really started for this company. So that's Snap. That's after the bell today. But we also have EA and Spotify to look forward to today. And then we get to the real heavy hitters. I'm talking about Meta, Peloton, Alphabet, Amazon. And if we think about what's going to be the topic of conversation, it's probably going to be cost cutting, layoffs, and margins, all going to be in focus as the pandemic era boom fades for a lot of these companies. And John, the stakes are high when you think about the big tech resurgence that we've seen so far to start 2023. The NASDAQ 100 at this moment, it's up about 9% so far for the month. That's the best January since about 2019. So we could be setting up for a big reality check as these earnings roll in. And you can't forget the Fed tomorrow.
What a run. Katie, thank you. Year to date, to Katie's point, you've got to talk about it over the last 12 months plus, but year to date, Snap up by 25%, Meta up by 24.4%. Worth pointing out that when it comes to Snap, just look at the price action over the last quarterly reports we've had. On October 20th, the stock was down 28%. In the quarter before that, the stock was down 39%. That's 1 day price action after the results. So that probably gives you a decent idea of some of the moves you can expect in a name like that one. Social media stocks having a great start to 23 after a major down year. Citi's Kristen Bidley telling investors to stay cautious on the rally.
I don't like this rally. Going into the end of last year, you had a lot of tax loss harvesting. You also had the most bearish positioning that we've seen since the global financial crisis. And when you look at what's driving this rally, it's all of the laggards and losers from last year. And so this is more of a technical rally. It's not something that has fundamentally changed.
Crossmark's Victoria Fernandez echoing that view and looking ahead to Chairman Powell writing the following. We still aren't completely convinced that there is an all-clear signal for a sustainable rally. There is quite a bit of macro uncertainty, but at the same time, we have companies saying things are looking pretty good. This gap is what is going to be difficult for the Fed to decipher. Victoria joins us right now. Victoria, first question then. Are you loving this rally or hating it?
Well, I'm not loving it. I don't want to say I hate it because I think you can be opportunistic in this rally. You can trim some names that have done really well, take a little bit of money off the table and put it off to the side and wait for an opportunity to do something different. So don't hate the rally, but I don't think we're in a sustainable rally at this point. I just don't think that we have cycled through the things we need to, through the earnings, through the rest of the rate hikes, through the rate hikes that we've already had and their effects that are going through the economy. There's so many different elements out there that we still need to churn through before I think we can say we're in a sustainable rally, but use it to your advantage.
So how do you use this to your advantage?
Yeah, well, look, I mean, some of it is what we were just saying. So we've trimmed American Express. You know we like financials. It was one of our favorite sectors last year. We like it again this year because they have strong balance sheets, and we think that rates are going to continue to go a little bit higher from where they are here. But you have American Express that's up 12% year to date. Why not trim some of that, take some of that money off the table, put it into some other areas? Names like Lowe's, names like Aflac, we like insurance, or General Mills. I mean, you can find other areas in order to put some of that cash to work, but I don't think you want to make big bets at this point in time. There's just too much uncertainty, and we do think we're going into a recession probably around the middle of the year, so you need to be careful.
Well, let's talk about those big tech names that have rallied hard, and let's assume you're right. We go into recession pretty soon in the next couple of quarters. Victoria, how do you think those tech names perform in that recession?
Yeah, I think it's going to be quite difficult, Jonathan. I mean, obviously, we've had a little bit of a rally here, and in my opinion, it's an oversold rally, right? People are coming back in, names are at the bottom, and that's fine if you didn't have these names in your portfolio and you're trying to build a little bit of a position. But I think you have to be very cautious. These names are still in downtrends. So when you have starting to get an overbought position in a downtrend, that's a really dangerous place to be. And look, like I said, I don't think it's a sustainable rally. You want to look for new leadership once you hit the bottom of the market and you're starting to turn and have a sustainable rally. You want new leadership. These are the names that led last time, so I don't think it's where you want to look going forward. Have a little bit of exposure, but be cautious.
Victoria, let's just build on that just a little bit. Why are we so convinced there will be new leadership. I hear that from a lot of people. I've heard that a few times already this morning. Why are we so convinced we get new leadership? There are some people out there who just believe we're a couple of rate cuts away from old leadership reasserting itself and big tech absolutely flying.
Well, and I think that's the issue. A couple rate cuts away. When are we going to get rate cuts, Jonathan? I don't think we're getting them in 2023. I think the Fed is going to raise, obviously this week. They're going to raise again in March. I think they're going to hold for the rest of the year. So if you're waiting for rate cuts to give a rally to the tech names, I think you're waiting at least a year from now. So there's better places to be in the next 12, 18, maybe 24 months instead of these names. And I know everyone, I mean, it's the tradition, right? That you're going to have new leadership coming in, but there was so much brought forward during the pandemic for these names that I think you have to take a step back, say thank you for the gains that you've given me. Now we need to look other places.
Chairman Powell speaks tomorrow. Victoria, what are you expecting from him?
Yeah, so I think we'll get a 25 basis point hike. It's what's priced into the market. But I think where I differ probably from other people is I think he's going to remain somewhat hawkish in the press conference. I mean, if you look at all of the items that people are saying, this is why the Fed needs to stop. We have a stronger economy. Even though growth has gone down, it's somewhat strong. We've got consumers with demand that's there. We can have a soft landing if they just stop now. But these are the same elements that I think Powell is looking at to say we haven't gone far enough. We know the Fed wants to err on the side of higher rates. They're willing to go into a recession. They've told us this. So I think he's going to be a little more hawkish in the press conference than maybe what the market is pricing in. And I actually think there is a risk they could go 50 basis points based on the strong labor market that we're seeing, the GDP numbers, inflation numbers still being sticky. I know the ECI numbers came out today and they were a little bit lower than expected, but on an annual basis, we're still over 5% for wages and salaries on ECI growth. So I still think there could be an opportunity for 50 basis points tomorrow, but a slim one.
You think they can go 50? How do you think that would be received?
I don't think it would be received well. I think the market would be very upset with that. Like I said, there's a big gap right now between what the market expects is going to happen and I think what Powell is laying out in his plan. You can see it in the rate cut expectations. There's already at least 25 basis points worth of rate cuts priced in for either September or December of this year. I just don't think we're going to see that. I mean, Jonathan, let's look at these recession indicators that we have going right now. You have LEIs up over 7% year over year, the inverted yield curve, M2 growth. We haven't even talked about what's going on with M2. There's all sorts of elements wrapped up into M2 growth, still $4 trillion of excess there, which is why financial conditions are easing. So I think Powell could go 50. I don't think it will happen, but he could.
Let's say it goes 25, and you know for the market it's not about what he says, it's about what he does. And what he's going to say is one thing, how this market responds to it is another, and that's why we've got to make two guesses tomorrow. Victoria, you've got to guess what he's going to say, then you've got to guess how the market's going to respond to it. Now let's say he says that the easing of financial conditions over the last few months is unwarranted. Do you think the market's actually going to respond to that in a material way, Victoria? Because over the last couple of months, they've all been on the same page, they've all been saying the same thing, they're saying what you're saying, which is no cuts this year, and yet still we're priced for cuts. Why does that change with the words of Chairman Powell tomorrow?
I'm not sure it changes with his words because the market, I think, is actually looking through some of what Powell is saying. They're already looking towards the end of the year and into next year where they think it's all going to end up in the same place. The timing may be a little different, but the end game they think will probably be the same, which is somewhere around a 5% terminal rate. So I think the market reaction tomorrow would be if we got 50 instead of 25. You might have a little bit of movement from the press conference if Powell is extremely hawkish, but if he sticks to his story, I think the market says, yeah, we've heard this before. We're going to continue with what we think is going to happen with the assumption that the Fed is going to match the market instead of the other way around.
Victoria, this was great as always. Victoria Fernandez there of Crossmark. About 13 minutes into this, equities at the moment positive 1/3% on the Nasdaq, up 0.6%. Coming up, GM delivering a stronger than expected outlook.
Our engineering and manufacturing teams partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021.
That's next, plus the EV pricing war heating up. Ford following Tesla with price cuts. That conversation just around the corner.
the quality of our launches and the new vehicles that we've brought to market are really being received well by our consumers. Our engineering and manufacturing teams, partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021, and we've been seeing vehicles move very, very quickly once we get them to dealers.
GM reporting better than expected results. The CEO, Mary Barra, giving an upbeat forecast, writing the following: "We expect our momentum to help us deliver strong results once again in 23." Kaylee back on a story. Hey, Kaylee.
Yeah, that 2023 guidance much stronger than expected. They expect profit between $6 and $7 a share. Even at the low end, that tops the average analyst estimate at $5.70. So a really healthy beat there. What's driving that is healthy volumes. Sales volumes were up 41% in the fourth quarter from the levels a year ago, and they expect that volume to be up 5 to 10% this year as well. That's helped by the fact that supply chain constraints are easing, so they're able to increase production, and increasing production of electric vehicles in particular. Mary Barra saying 2023 will be a breakout year for their Ultium platform, and that they're on track to produce 400,000 EVs in North America from 2022 through the first half of next year. So put it all together, and the market really likes this. GM up 8%, lifting peers higher as well, just continuing the outperformance we have seen from autos this year. But we know the autos narrative has changed in recent days, John, amid buzzing about a price war. We got some interesting comments coming out of the analyst call in relation to that. Mary Barra saying that the models are priced where they need to be, and the CFO, Paul Jacobson, saying he may see more discounts on models increasing this year, but he went on to say they are not preparing for a price war, John.
And no cuts just yet. No big cuts anyway from them. Stock's up by more than 8%. Kaylee, thank you. Kaylee talking about that EV price war heating up in a big way. Ford slashing prices on its electric Mustang in response to Tesla's recent discounts. RBC expecting more cuts on the way, seeing a cascading effect across the industry. Bloomberg's David Welch joins us now in Detroit for more. David, can you run me through what you think about what we've heard so far from Ford, from Tesla, and what you're expecting next?
So if you look at the price cuts that Ford and Tesla made, they are big. It does tell you that there's serious competition now in the electric vehicle market. But in a way, a lot of what they did was scale back price increases that they had put in last year when everything in the market was scarce, including internal combustion vehicles, and everybody was fighting to find chips to build EVs, gasoline-powered vehicles, everything. So now that demand's a little softer, now that you've got more competition than just Tesla in the EV market, and Tesla has a lot of production coming online, by the way, you're seeing this pullback in pricing. Very interesting that GM doesn't think they're going to have to do that. And here's where I think they're going with this. First half, they're going to be slowly ramping up all of these Ultium-based vehicles, like the Hummer SUV and the Hummer pickup truck, the Cadillac Lyriq, and then eventually you have 2 Chevy SUVs that will compete directly with the Mustang Mach-E and with Tesla models, and you'll have the Chevy Silverado pickup. But the real production boost for General Motors will be in the second half. So they probably don't need to discount anything right now because they don't have that much production to sell. It's not like there are a bunch of General Motors made electric vehicles sitting on dealer lots that need a discount to move. So in the near term, they're probably right. Second half is where I think you'll see the true test of whether or not GM has to discount, because you'll see these vehicles that compete directly with the Mustang Mach-E, like the Chevy Blazer, like the Chevy Equinox. They also compete with Tesla Model Y and Tesla Model 3 in terms of price range. And that's when I think you'll see the pressure with these new vehicles coming out, and then we'll know whether GM is able to hold price there or not.
Hey, David, very well framed. David Welch there out of Detroit. GM up by more than 8% right now. Got some breaking news for you in the last couple of minutes, just on some economic data. Here's Mike McKee.
Tying it in well, John, because the Chicago PMI is generally related to how the auto industry is doing. A lot of manufacturing plants there, and it's down slightly, 44.3 from 44.9. It was forecast to go up just a little bit, so they're still struggling with some contraction in the Chicago manufacturing area. Tomorrow, the ISM manufacturing comes out. That's going to be the interesting one that everybody wants to watch. The regionals have all been mixed, half up, half down, so no good call on that yet.
Put it all together, Mike. 25 just now done. We heard maybe 15 minutes ago Victoria talking about the potential for 50. How surprised would you be by a 50 basis point hike tomorrow?
Less surprised than I would have at some changes in other meetings, but I think they've left the impression they're going to do 25 at the markets, and there's no real reason to surprise the markets now.
Mike, looking forward to your coverage, as always. About 22 minutes into the session here, we advance a third of 1% on the S&P, on the Nasdaq up a half of 1%, with some sector price action. Here's Abby.
Hey, John. Well, we do have most sectors higher with that small gain for the S&P 500, and consumer discretionary really performing on that GM quarter. UPS also putting up a good quarter. So both of those shares higher. GM up by about 8% as we saw, UPS by about 3%. So that is the sector that's leading, the materials, communication services. On bottom, energy, utilities, and financials. And it's interesting, we are, of course, in earnings season, as you know. And relative to the sectors that hold on to post-number gains, well, it's discretionary. And this number so far up 3.7%. It's likely to go higher after today with GM and UPS. We also have materials, communications, and financials in there. The industrials also holding on. We'll have to get tech in there and see what's going on for that tech sector, whether or not those stocks hold on to the gains.
Abby, thank you. Looking forward to Snap a little bit later. Your trading diary up next. In 23 on the Nasdaq, we try and bounce back by 0.6%. On the S&P, up by about 0.4%. That's the price action. Let's get you the trading diary. President Biden in New York discussing infrastructure at 12:30 Eastern. A Fed rate decision, Chairman Powell news conference on Wednesday, followed by earnings from Meta. Rate decisions from the ECB and BOE coming on Thursday, plus results from Apple, Google, Amazon, all coming up. And finally, jobs day in America to round out the week on Friday. Special coverage of the Fed tomorrow on this show. Fantastic lineup for you. For the 9 o'clock hour, we have Kathy Jones, Bob Michael, Chris Harvey and Mike Wilson, all coming up tomorrow, 9 o'clock Eastern time. Do not miss that. Looking forward to covering all those stories with you. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, January 31st. Here are the top market stories that we're following for you at this hour. Turning point. IMF upgrades its global growth forecast for the first time in a year. Things didn't get worse, while saying the fight against inflation isn't won. And the earnings tide doesn't lift all boats. Caterpillar struggles with higher costs. McDonald's warns of more inflation, while GM beats. We're going to get you the latest with David Kostin, Goldman Sachs chief U.S. equity strategist. And farewell, Queen of the Skies. Boeing draws the curtain on its jumbo jet with its final 747 delivery. We are live on the ground as we look ahead to what's next. From New York, I'm Alex Steele with my co-host in London, Tom McKenzie. Guy Johnson is on assignment in Seattle. Welcome to Bloomberg Markets. It is a tremendous end to a January where I feel like what I don't have clarity on, Tom, is what's going to lead. Is it going to be earnings? Is it going to be the Fed? Is it going to be the ECB? We're kind of biding time now.
Yeah, it's a mixed picture on the earnings front, but of course the markets right now seem to be focused on the employment cost index, or at least the data in wages coming through a little softer than maybe some had expected. Here in Europe, it's once again, it is good news is bad news, and you had that Eurozone data coming through for GDP, slightly stronger than expectations, and then the money markets, again, starting to price in a more hawkish ECB. So there is that divergence, and how the markets play that and adjust in this important week is going to be crucial.
Yeah, it is, and we also have some more data coming out. Tom, let's bring us that. You got consumer confidence for January slipping slightly, but still sequentially higher, coming in at 107.1. You have also December revised a bit higher. Also, though, this is interesting, Tom. Expectations starting to slip, and present situation, though, a little bit better. So that's a little bit reverse of what we saw, right? So we might not feel that good right now, but we may feel a little better in the future.
And again, that's going to be tied, isn't it, to the cost around energy, and particularly gasoline prices, and the strength of the US consumer and how that continues to play out. We talked a lot last year about the balance sheet, household balance sheet, whether that gets eroded, how quickly, and what that means around the strength of the consumer and how you overplay or overlap gasoline prices into that. Really interesting as well when you look and compare to the Eurozone data. Again, there's this expectation that as inflation possibly starts to come off, maybe that leads to slightly stronger growth then, but that also ties in and potentially empowers the ECB to have to go further. It's pretty fascinating, the lack of clarity around this data.
It's definitely really confusing. Also, we've been talking recession for a while, so are we worried about recession right now? But in the future, we're going to be okay. That's what happens when everyone's talking about the same thing and there's some kind of consensus around a recession. Anyway, interesting data to kick it off.
Okay, turning now to the global economy then, just expanding the picture a little. The IMF sees a turning point for the global economy. It raised its growth outlook for the first time in a year. We spoke earlier with the IMF's chief economist.
What we are looking at is what effectively is going to be still a challenging year, but still it's an upgrade compared to what we were expecting back in October, and this is due to resilience. We've had more resilient households in the US, resilience to the energy crisis in Europe. Labor markets have been very, very tight. And then in addition to all this, you have the reopening of the Chinese economy that is promising to give a boost to global activity.
So resilience was the line there from the IMF. It takes us to the question then, our question of the day, turning point. Are we at that? What does that mean then across these markets? Let's bring in Bloomberg's Jess Menton and Michael McKee. Mike, let's start with you as we look ahead to that Fed decision, of course, on Wednesday, and how you parlay that wage data into the decision making. As again, one of the top red stories on the Bloomberg is Waller outlining 50 basis points, 25 basis points down to May, where potentially we pause.
Yeah, I think the thing about Chris Waller's statement the other day was that he said he needs to see 6 months worth of data. The ECI is 3 months worth of data. It's quarterly, but we've also seen inflation falling for the last 2 months, and basically it's significantly lower on a month over month basis than it was earlier in 2022. So they're starting to see what they want to see. They're also seeing evidence that the economy is slowing down. And so there is a reason for them at this point to dial back to 25 and not feel the need to go to 50. But does that count as a turning point? That's the hard part to divide here.
Sort of, like it is a different, is it a change? So for the market though, Jess, are we at a turning point in the market, or did we already do that?
Well, that's the million-dollar question. And if you're looking at what the big theme is from this earnings season, big misses are escaping big penalties. So if you pull data from Bloomberg Intelligence and you're looking at what's happening when it comes to those misses, they're the least negative that they have been in 8 quarters. And so companies that are beating on sales and EPS, they're actually outperforming in the S&P 500 on earnings day by close to 1.5%. And that's actually beating a 6-year average. So you're seeing, and basically it's just a signal that those expectations coming into this earnings season were just so low. But if you're looking more broadly now at the outlooks, I mean, clearly we heard from Caterpillar. It did post its first quarterly miss since 2020, but still revenues came in better than expected. But not surprisingly, the issue there was when it came to the profit margins, which has echoed the sentiment when we were thinking about other companies, especially in the last few quarters. But then McDonald's, the other issue that it came in, even though its fourth quarter sales did beat expectations, it came down to that operating margin. As far as those projections, it did come below what Wall Street was expecting. So that is still the key issue there when you're looking at profit margins. But when I'm speaking with my sources, when they see a lot of these sentiment indicators, when they are still tilted very negative, even despite the gangbuster January that we have seen with the S&P 500 with its best January on course since 2019, that still makes them think that they should be on the other side of that trade, and they want to still be bullish going into this year since there is sentiment that still is so negative right now.
Okay, and it's the resilience of those margins and confronting a potentially slowing economy, or certainly a slowing economy, whether it's recessionary or not, we still have to find out in the US, Mike. And part of that, part of the focus certainly tomorrow will be listening in for Jay Powell and anything he does to push back on what remain pretty loose financial conditions.
It's going to be a little bit of a task for him because the economic situation has gotten better with inflation coming down. And so far, unemployment still hanging in at a very low level. And we're not seeing a recession in the numbers yet. We're seeing a slowdown, not a recession. So he can't ignore the fact that the economy is in a pretty good place right now, but he also doesn't want the markets to go off and running and start pricing in rate cuts. They already have, but to do even more. So he's going to walk a fine line there, and I think their strategy is to talk about how they are going to keep interest rates at a high level for a long period. That's something they can always change if the conditions change. They can go up again or they could start going down. But right now, the forward guidance is going to be we get to 5 and we stay there.
So, okay, can we take that, Mike, and talk about the turning point thing? So if that's not a turning point for the Fed, I feel like in some ways it is a turning point, though, for the Fed versus ECB, because if the ECB is going to go 50 and be super hawkish, it is a turning point that, okay, maybe inflation isn't going to skyrocket, maybe growth isn't going to tank, but the turning point is a huge central bank divergence in a way we haven't seen in a while.
Yeah, you're going to have that because the Fed started much earlier than the other central banks, and you've got the ECB trying to catch up. I mean, GDP in the Eurozone still extraordinarily low. They just escaped a recession, and the reason it was positive basically is because Ireland got all the money. But if the ECB has to keep going with inflation, and we're going to see interest rates differentials start to narrow, the Fed's way above everybody else, start to narrow. The Bank of England still looking at raising rates because they've got an inflation problem. And now, come April, there's a lot of focus on the Bank of Japan and what they're going to do. So we're still going to see higher interest rates around the world for a while, even if the Fed sort of backs off and holds steady.
Ah, yes, the Bank of Japan, yield curve control, the next governor, where they're going to have to abandon that. Jess, when it comes to the pivot in terms of the earnings picture, if we do get to a place where the Fed is comfortable on a pause come May, what does that do in terms of the pivot to riskier parts of these equity markets?
Well, we're already seeing that in the first month of this year. So the best performers in the S&P 500, if you're looking at the sectors, it's discretionary, communication services, also technology. These were last year's biggest beat-up sectors, and now they're outperforming. And if you're looking at the losers this month, it's not surprisingly, it's more defensive corners of the market. So you're looking at staples, healthcare, and utilities down. So the question remains, is this more of a mean reversion because of the punishment that a lot of these different groups had last year, or is this something that's more sustainable? When I've been speaking with my sources and and portfolio managers, they're still positioning more toward value-type oriented sectors, whether it's energy, industrials, just because they don't think the global economy is headed for a severe downturn, especially when you look at what copper prices are doing, what that means as a barometer for the global economy, as well as the trajectory for the equity market and the types of components that copper is used for in those types of sectors. And so they're still betting on value, but the question obviously remains is, can you have that type of leadership group to carry the index back to those types of record highs? And that obviously remains to be seen, but that will be key to see, especially what the IMF is arguing. If we do see economic growth bottom sometime this year and pick back up in 2024, that could bode very well for the equity market.
I love how we're all getting excited about 0.7% growth, right? I mean, that seems pretty funny. All right, thanks a lot, guys. Mike, Jess, really appreciate it. Thank you both very much. Coming up, more on a question of the day. Turning point, we're going to ask David Kostin, Goldman Sachs Chief U.S. Equity Strategist, next. This is Bloomberg.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I believe that the stock market is way too overvalued for interest rates that are not 1%. So unless they miraculously bring back interest rate to 1%, which they won't be able to. So this is why the stock market has to adjust to normal levels.
That was the Black Swan author, Nassim Taleb, on his current take on market valuation. Disneyland is over. Pretty harsh. Our question of the day pivots back to what the IMF was talking about. Is this a turning point for the global economy? Let's get the equity take here with David Kostin, Goldman Sachs Chief U.S. Equity Strategist. David, the thesis, right? Inflation is slowing. Growth isn't terrible. We may be past the worst of it. That's the idea. But we still got to tame inflation. How does that segue to the equity market?
Well, it segues to the equity market in that margins are still falling.
And we look now in the fourth quarter results that are coming in. Year over year, earnings are down 1%. They're likely to fall year over year in the first quarter and in the second quarter. So you're still looking at a number of months of headwinds in terms of profits. And one of the reasons for that is that the margins are declining. And so therefore, the best that you get is flat earnings year over year for 2023 compared with 2022. And that's a problem because the only driver, therefore, in terms of the equity market is likely to be valuation. And relative to interest rates or on an absolute basis, equity markets in the United States are at the 85th percentile relative to history, so it's very expensive. Not the most expensive, but certainly expensive on a historical basis. And so that really does create some impediments to having the equity market move a lot higher, which is why at this level, around 4,000 is likely where the market will end this year in 11 months from now would be my view. We could talk about the path, but I think that's a framework, earnings and valuation, that does put some restrictions on how much higher the market's likely to trade.
Okay, so David, earnings stateside, you're looking flat for the year. Valuation's still looking pricey, as you outlined for us. Where does that take you? Does that take you to Europe?
Takes you to Europe, takes you to Asia. Better opportunities, first of all, from a valuation perspective. Simply put, much lower multiples. Instead of 18 times earnings, you're basically 12 times in Europe. And depending on which particular market we look at in Asia, also relatively low. Much faster earnings growth, of course, coming off of pandemic restriction low in China, but broadly speaking, better return opportunities outside the United States. And fund managers are probably positioning or starting to position their portfolios with respect to that as a sort of as a base case scenario. Again, the best case scenario is the economy here has a soft landing and there's no recession, which is our baseline assumption. Right. And you're also avoiding a recession in Europe, in our view, because better weather that's fortuitous.
So David,
and China's reopening sooner than we had originally anticipated.
So David, then what do you make of what we saw in January? Like consumer discretionary up almost 14%, communications the same, real estate still up 8%, tech, infotech up 8%. The S&P having a solid run. What do you think happened in the last 4 weeks?
Well, there's arguably some short covering that took place. There's argument that the inflation is coming down, so the concern or the risks of a recession have certainly receded dramatically in terms of, in the minds of many portfolio managers. It's more moving, or the view of the economic outlook has moved closer to the Goldman Sachs baseline view of a soft landing, and that would benefit some of the cyclical stocks. But when we look at the relative performance, Alex, of cyclical stocks compared with defensive stocks, it's lining up with an ISM that's just about 50 or a little under 50, which is pretty much where the market's trading. So from a pricing point of view, what's priced in the market is the soft landing scenario. That's sort of the best case scenario as we would see it, and the market trades around fair value in this environment. And I think that's our starting point right now. The revisions have been negative. The breadth of revisions have been as negative now as you saw in 2009 and in 2020, both obviously for independent reasons, sharp downturns and recessions. That's not our expectations, but the breadth of negative revisions and the magnitude of revisions are coming at the lower end, even below what they were tracking in 2008. So the concern is on the profits, largely driven by margins rolling over. Margins rebounded dramatically from the pandemic low. They hit a peak in the second quarter of last year, and they rolled over in the third quarter. And in fact, they're rolling over even more significantly here in the fourth quarter results. Obviously, we're now in the first quarter. So that's the fundamental, issues that are confronting the market. And with respect to the rally in the market, it's the idea of a recession risk receding. I think it would be my, explanation of why you've seen the market rally in the first quarter.
So that soft landing forecast that you could still hold on to, when do margins bottom then, given that view? Does that start to bottom in fourth quarter of this year?
Do they bottom in the fourth quarter? That's it's a possibility, certainly. The risk there is, what are the contributions for why margins went up so much, Tom? Therefore, what would have to be reverse, if you will, in the retracement that we're seeing right now? Well, it's been a diminution in the cost structure of labor, and it's in a diminution in the cost of goods sold. Those two were the building blocks for why margins expanded so much. Now we look out, and labor costs would be one variable to look at. Do we see labor cost inflation, dissipating or diminishing? That would be one issue. And the cost of goods sold for companies, is that likely to reverse, if you will? And the concern there is the supply chain, the nearshoring, some of the increased inventory builds that companies have been having to, address just in case as opposed to just in time inventory. Those decision processes are what would have to be reversed, because right now those would be the headwinds for why margins are likely to come down and come lower in the as the course of the year. With respect to whether that's in the fourth quarter, whether that can bottom, there's been a huge secular move. We got higher interest rates, we've got higher tax rates. Something we wrote about in our commentary, which we published on Friday afternoon. These are some of the variables that would be, a headwind to margins. Returning to a higher level, and therefore they're probably likely to be more of a mean reversion. In my forecast, your net margins are likely to be back this year, back to where they were in 2019, back before the pandemic. And so I think those are challenges that a lot of managements are facing, and you're seeing that in the results that companies are reporting, which are generally speaking disappointing. There's been fewer positive surprises and more negative surprises than we've had historically in the last 4 or 5 quarters. And so that tailwind of margin expansion is not what we're experiencing and have experienced really in the last couple of quarters.
Yeah, and just look at McDonald's. Like, they don't necessarily see inflation going away. Same with Caterpillar. It's really across the industry there. David, always good to catch up with you. David Kostin, Goldman Sachs Chief U.S. Equity Strategist. A pleasure always. Still ahead, Samsung defies the chip downturn, keeping capital spending at the same level despite expecting a contraction in the smartphone market. We're going to get more on the startup coming up next. This is Bloomberg.
Jobs day like Bloomberg.
All right, it is almost 24 minutes past 7 on the West Coast. Want to get to the startup where we cover those top tech stories in the Bay Area and beyond as Silicon Valley wakes up. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, I'm looking at NXP. Based on earnings, I'm looking at Samsung. The quarterly chip profit division fell like almost 100%. Did we learn anything from these chip guys over the last 24 hours?
Yeah, it's relatively consistent, right, that in the first half of this year, and I'm talking across Samsung and NXP in the last 24 hours, but you go back to Intel last week, Micron in December, the glut or the backlog in inventory for all kinds of chips, but in this instance, memory chips, is not going to work itself out until the second half of this year. The prices of memory chips in particular have fallen significantly. I'm talking about DRAM that goes into smartphones, PCs, and the story with Samsung is this commitment to invest, commitment to improve capacity despite demand not being there and this falling prices. Why? Well, for them it's a story about long-term demand, not being so focused on the here and now, but saying over the course of multiple years we need to be prepared for when demand comes back.
Ed, I want to get your views on this decision by the US to at least consider further restrictions, basically banning any supply of kit to Huawei.
Yeah.
They've already, of course, choked it off. The smartphone business has already been crushed. What was the rationale? What are they looking to achieve with this?
Yeah, I think that the rationale is a continued focus on the Biden administration on the need to be strong on China. So sources are basically telling Bloomberg that there will be no exceptions to the entity list. Under Trump, Huawei was placed on the entity list, but some US companies like Qualcomm, like Intel, could get licenses and approval to sell technology to Huawei. What sources are saying now is that new applications are likely to be rejected, and applications already in the system will just basically be put on hold indefinitely. It's just a strengthening of the response to Huawei and a sort of firmer action than Donald Trump's administration took. But sources, of course, stress to us that no decision's yet been taken.
So at this point, it feels odd that chip companies haven't already moved ahead of something like this, because we know that Biden has been more aggressive in some ways, but ASML still is kind of dealing with the aftermath. Like, who's not prepared for something like this?
Well, there's two separate issues, right? There's the Huawei issue specifically being on the entity list, and Biden's look at it. Then there's the access of China to technology, and in that access to technology, there are names that have lowered the threshold of their tech to get it through the restrictions, and there are people that are mitigating the exposure to China.
Ed Ludlow, thank you on that response, potentially coming through the pipe from DC to Huawei, adding to the restrictions, and of course looking at the Samsung earnings and their investment commitments coming up, plenty more, including a focus on Caterpillar. This is Bloomberg.
4 into the U.S. trading session. We have another rally underway here after a really crazy kind of January. Abigail's tracking those moves for us. Abigail?
Here is that January. It's incredible, Alex. Look at these gains. We're looking at the best month for the S&P 500, up more than 5% since January of 2001. The NASDAQ 100 up nearly 10%. Its best month since July of last year. Who would have guessed this given the bearish action last year? But investors are all in at this point. Now, we did have some economic data come out this morning, a bunch of economic data, but one of them being housing. Housing still in a recession and investors really not caring. Now, if we look back at the 2011-2012 area, we will see that prices declined per the Case-Shiller index. We also had mortgage rates below 5%. What's interesting here is as mortgage rates went above 7%, you can see that prices clearly dipped down. But now we have mortgage rates dipping down. It's not really affecting so far the housing market, which did slide 0.3% on a month-over-month basis from November from October. So let's see what happens next. As for ExxonMobil and Chevron, well, ExxonMobil reported this morning. We already know what Chevron did. ExxonMobil, a tremendous quarter. They put up $59 billion in net income. So together with Chevron, nearly $93 billion. Now, there was a buyback disappointment, but relative to ExxonMobil, they're the first non-financial to have an annual year of more than $75 billion worth of cash generation. Really pretty impressive. As for some other movers on the day, in terms of at least seeing the stock movement, we do have General Motors up 8.2%, a great quarter. They beat both top and bottom line. They're really kind of shrugging off this EV pricing war that we're seeing between Ford and Tesla. UPS up 3.9%, a solid quarter there. They missed revenues, but profits okay. Investors seem to be liking it. McDonald's, not so much though, down 2.6%. Their fourth quarter margins a little bit under attack, and the CEO did comment that customers there are trading down. So a little bit of weakness, nonetheless, saying that customers are mainly resilient. And then finally, Caterpillar at session lows, Tom, down 4.5%. Interesting because overall the quarter was very good in terms of revenue and demand, record backlog, but profits missed by 3%. Investors really focused on that fact. You could also tie in the fact that this stock at a record high last Friday. Price to perfection, not quite perfect, stock down.
Okay, yeah, that's important context. We're going to stay on that story and dig more into it. Abigail Doolittle, thank you very much indeed. As I mentioned, continuing with earnings and that miss from Caterpillar, Kristen Owen, Oppenheimer Executive Director, joins us now. She has a market perform rating on the stock, and she just got off the Caterpillar analyst call. Talk to us then, Kirsten, good morning, about what stood out for you, Kristen, I should say, from that earnings call, and do you have any expectation that you get to outperform on this stock by year end?
Yeah, I mean, I think we learned a lot on this earnings call. What we were looking for, updates on dealer inventory, the backlog, which grew in spite of deliveries being really strong in the quarter. You know, I think it's important that we take a step back and really look at some of these headline numbers. There was a lot of what I'll call noise in the reported numbers. What we see is, you know, an EPS miss of 16 cents relative to consensus estimates, but that includes almost 41 cents of foreign currency impact. On the top line, it looks like a 5% beat, but if we start to peel back the layers there, what we see is a $800 million impact from dealer inventory builds on a year-over-year basis. And that makes up for almost the entire top line beat. And that's, I think, what's actually sticking in the craw with investors right now is they're looking at, you know, a stock that is priced for perfection, priced for reopening trends and infrastructure bill, and yet we're seeing that dealer inventories are building, and that's created some pause.
Kristen, do we have any visibility as to why? Because I automatically assumed that this was going to be a margin thing. Like, they can pass on their price increases and offset manufacturing and freight costs, but like, for how long? That was my interpretation initially. Do we know what's going on with the dealer inventory situation?
Yeah, I mean, the fact that the supply chain has started to loosen up a bit has enabled those dealers to increase what they've got on hand. Sales to end users still strong and strong across the portfolio. But I think in that North American construction market where CAT was able to deliver more units to dealers, that's causing some pull through on demand and is expected to be a $2.4 billion headwind to 2023 revenue outlook.
Wow.
What is the China demand looking like for this business?
Yeah, and China is an important driver for sentiment in the stock, even though it ends up being less than 10% of revenue for CAT. And what they said is, look, 2022 was down. We've had some great years. 2023 expected to be down again in that greater than 10-ton excavator market. And I think that is also pulling the sentiment in the stock down a bit, because we have seen the stock run up on, China reopening trends.
Doesn't this mean at some point, though, that Caterpillar is going to lose the ability to pass on their costs?
Certainly, I think that there's some question around reduced price inflation and what that means for price cost on a go-forward basis. I mean, when you see dealer inventories increase, we would anticipate the CAT's ability to continue to price at these premium levels gets weaker. Now, from a price cost basis, or from a price cost margin perspective, that should be beneficial to margins in the back half of the year.
Okay.
Kristen, can you give us a little bit of color on how the breakdown is looking across the different business segments, whether it is construction or indeed the mining part of the business?
Yeah, certainly on sort of what I'll call like the mining, resource, and E&T areas of the business, what we're seeing is commodity prices, while off from highs, are still favorable for investment, but those customers have and continue to be very capital efficient and smart with how they're using their capital allocation plans. On the construction side, we are seeing that non-res, which represents about 25% of Caterpillar's construction revenue, is slowing. It's still healthy, but slowing, whereas infrastructure, that remaining 75%, remains pretty healthy.
So, Kristen, I know you don't do price targets on the stock, but I'm just wondering, if we were priced to perfection, how much potential downside could there be as we have to kind of reset some expectations here on the margin front and the dealer inventory in that first half?
Yeah, I mean, from a valuation perspective, we've been trading at about 18 times is where the stock's gotten up to. And that really represents sort of a mid-cycle multiple. I think we're probably looking at, if I'm pricing upside to downside, the historical range has been more along the lines of 15 to 20 times. So you've got about 3 turns of multiple that have been baked in, assuming that these end markets have been a little bit more troughy and that there's upside from there.
Just briefly, what does this do to their investment plans? Are they going to have to derail or at least delay some of their investment plans in the 6 to 12 months ahead?
It's an important consideration for the 2023 guidance. I mean, it does assume that those investment dollars continue to flow. I think they're investing in, the alternative energy space and ensuring that they have a seat at that table. I think that's important for CAT. When you talk about the opportunity in mining, the electrification of everything, it's really coming at the cost of what's happening in natural resources, oil and gas. So they need to continue to make these investments, and that is reflected in the margin outlook.
Kristen, great stuff. Really appreciate it. Thank you so much. Incident Analysis, Kristen Owen, Oppenheimer Executive Director. Thank you very much. All right, coming up, you got Boeing bidding farewell to its iconic 747 jumbo jet as the company pivots to more sustainable air travel. We're going to be on the ground outside Seattle. Plus, how biofuels are trying to make commercial flying greener. Todd Becker, CEO of Green Planes, tells us about the company's new deal with United Airlines. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year. That's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The U.S. and South Korea plan to step up the scale of military exercises that have angered North Korea's Kim Jong-un. The drills have been scaled down or halted under former President Trump. In the past, North Korea responded to the drills with threats and weapon tests. And Brazil's former President Jair Bolsonaro is in no rush to leave Florida. Instead, Bloomberg's learned he's applied for a 6-month visitor's visa. That's making life uncomfortable for the White House, which will welcome Bolsonaro's successor and bitter rival Luis Ignacio Lula da Silva next month. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. The event of the day, Boeing ending production of its iconic 747 jumbo jet after a 54-year run. We flew Guy all the way to Seattle on like a bazillion-hour flight for this last delivery. He joins us now in a wonderful outfit. Guy, what am I looking at?
So this is the last 747, the last commercial 747 that Boeing will deliver. It's going to Atlas Air. It's going to be handed over a little later on today, and then it's going to fly out tomorrow, and that is it. Apart from, of course, Air Force One, which Boeing is still working on. It is a huge moment. As you say, this is a 50-plus year window in which this plane has dominated. It changed the world. It was the first wide body. It's carried space shuttles. It's carried presidents. It's carried 6 billion people, circa 6 billion people. It absolutely changed the world, and it was built by this group of incredible people that were known as the Incredibles. They did it in 2.5 years. Alex, this plane defined an era. This was the era when America pushed technology and innovation to its absolute limits. It was the Saturn rocket. It was the 747. The question is Boeing still able to do that kind of innovation going forward? I'm going to talk to Dave Calhoun, the CEO of Boeing, a little later on today.
I'm just zeroed in on that. Now, 6 billion people it's very over that 50-year period. Amazing. Guy, as you look at the future, as you look at innovation, what are you hearing from Boeing? What are you expecting to hear around their commitments to sustainable air fuel? How serious are they, and what kind of time frames are they looking at?
Well, they've got to be serious because aviation is going to have to change in order to meet the emissions targets that are being generated by government. So change is coming. Dave Calhoun has hinted about a new potential narrow body that they're working on with NASA. That would be huge, but he's also said that there will be no new planes from Boeing before 2035. So how does he motivate his team? How does he keep people here at Boeing working on the future? That's going to be a huge challenge and a question for him a little bit later on. I have to say, Microsoft are laying off people, Amazon are laying off people here in Seattle. Can they attract that talent back into Boeing? Why would that talent want to come and work here? I think is a key question for Dave Calhoun, because they're going to need that kind of talent to make the next big step.
All right, excellent stuff. Guy Johnson on the ground in Seattle. And of course, guys, exclusive interview with Dave Calhoun, Boeing President and CEO. It is today, 2 p.m. New York time. Okay, let's talk more about sustainability then, and the question of sustainable air fuel. Biofuel company Green Plains is announcing a new joint venture with United Airlines, of course. Here to talk more about the venture is Green Plains CEO Todd